You can't improve what you don't measure, especially before the year end wraps up. Businesses that regularly review their financials are 60% more likely to succeed than ones that don't. Yet, most business owners only look at their financials when it's time for tax season, which is already too late to do anything about them. So, what if a 30-minute review of your financials on a weekly or monthly basis actually made you able to make better financial decisions, help you plan for growth, and really give you more opportunity for long term success? Most business owners think that year end taxes is actually about filing your taxes, but the smart ones realize that year end tax planning is actually about looking at your performance over the year, seeing what went right and what went wrong so that you can plan ahead for the next year. If you're not quite sure what financials you should be looking at, I understand it's a little bit overwhelming for most people, but here's what we can help you. You are going to look at 6 key financial measures to analyze before year end so that you have a better idea going into the following year of where you should be focusing. One, you want to look at your revenue versus your goals. Did you meet your goals? At the beginning of the year, most business owners will tend to shoot revenue goals. That's just kind of by nature what we want to track. See how many sales we had, how many jobs you did, things like that. More than likely, you had a goal at the beginning of the year. How close were you to reaching that? Can you figure out, did you meet it? Were you under by a certain percentage? You want to look at that data and kind of figure out where you went right or where you went wrong. Point 2 is your gross profit margin. And this one can be a little bit confusing for some business owners depending on what industry you're in. So your gross profit is your revenue, and then you subtract out your cost of goods sold. Now, this can be anything like direct labor tied to a specific job that goes into your COGS, and anything that is directly related to the product or service that you're offering. As a gross profit margin, you want to make sure that you are staying within industry standards. A lot of the industries that we work with in particular, they have kind of a formula, for instance, that you can follow. Like if your revenue, 100% revenue, obviously, and then maybe your COGS should be 40% of your revenue. That is something that if you know what is standard for your industry, you can throughout the year be checking on this and making sure that even when you're pricing, that you are maintaining that percentage that you need to in order to remain profitable in the rest of your business. So to go along with that, after you look at gross profit, you want to look at net profit. Now, what goes into net profit? It's everything that's not related to that specific goods or service that you're selling. So this is your operating expenses, which may include any office expense, salaries and wages that are not included in the direct labor of your business, things like utilities, if you've got rent, all of those factors, they're like overhead. Overhead might be the best way to describe that, as something that you have to pay regardless of whether you're working or not, and it will impact the strength of your business. So your net profit margin, when I was talking about your gross profit, generally there's industry standards for what gross profit percentage you're looking for. You're also looking for a percentage of your net profit. Let's go back to that example. Your COGS were 40%. Let's say the industry standard is 15% net profit. So you've got 40% that's allocated to your cost of goods sold. 100% minus 40% leaves you with 60% available for the rest of your expenses, but you want to keep 15% of that. So that means that your operating expenses should also not exceed 45% of your revenue. Okay, so next you want to look at your cash flow. And your cash flow is important, and a lot of people think that it's a byproduct of profit, and it is and it isn't, right? You can have lots of cash flow, but actually still be possibly even a negative profit. You want to be planning out your cash flow over the next 3 months. You may have a business that's very like routine. You know what your income and expenses are going to be each week, but some businesses don't. It can be like a wild ride. You might get $100,000 in this month, and then next month you're living on beans and rice on, 10 grand coming in. So you want to be able to plan for that and even it out and be able to figure out what expenses need to come out of the money that's coming in, being able to plan ahead and see what money do you need to save for later expenses. Okay, the last thing, See, the accounts receivable aging report will tell you, do you have lots of outstanding invoices out there that you need to be calling and checking in on? Because that can help your cash flow. And really, that will help all of the rest of these things. Because if you have invoices sitting out there that, even if they were profitable and you were hitting all of these percentages, if they haven't been paid, that's money out of your pocket. So, knowing what metrics to look at is the most important piece for business. Knowing how to act on them is another. In our next video, we'll tell you what you should be doing.